Hey everyone, this is Brant from Wolf on Wall Street Trade. Let's see what the market has to say for itself this week. About a month ago, I did a video talking about this key reversal day in the S&P 500, that it was at 4,600, which was an important level for a couple of reasons. Psychologically, it's an important level. It goes all the way back to the 2021 bull market highs. And what I said at the time was this is like an exclamation point on the rally. And since then, since we traded above 4,600, we've just been trading down. But if we kind of scroll out a little bit, I just want to kind of give you some perspective here. You see this kind of lateral range. So that's kind of typical for the summer environment, summer doldrums, it's often called. And then earnings season on top of that, you tend to get a lot of lateral trade like we saw back here. I'm just wondering if anyone sees anything in this area that might look familiar to them in terms of price patterns. If you've been watching my videos, and certainly if you're a subscriber, you know something changed right over here in June where we started to see distribution or selling into price strength on 3C charts. Shortly after that, we saw a whole bunch of bullish uptrends broken, and now we're getting this kind of lateral sideways movement over here. So let's zoom in a little bit and we can look at this week and see what happened here. So on the week, it wasn't a huge week, but the S&P was up 0.8%. The NASDAQ was up 1.7%. So it outperformed on the week. The laggards were both the Dow and small caps, about 0.5% down on the week. So a mixed market, but obviously the mega caps did a lot better. We had a whole bunch of measured move targets for this downside, and all of them have been hit at this point. Okay, so they're no longer suggesting we have more downside to go based on the price measured move. So we have that. We also have a bunch of technical levels in play, like moving averages. So I'll run through those real quick. And you can always reference what these moving averages are up here. So the yellow is the 50, the dark blue is the 200, and the medium blue or light blue is the 100-day. So you can see the 50-day moving average acting as resistance for the S&P 500 specifically this week. So a lot of times when a moving average or support level breaks, it turns into resistance after that. So now it's acting as resistance. So not only there, but also in the Dow. Resistance right here, and we actually have some support at the 100-day in the Dow. Here are Dow transports, and you can see really clear resistance. Here is the NASDAQ 100, which has been the leader of the market for all of this year so far, 2023, and you can see resistance at an intraday high right there on Wednesday. Thursday, price opening above that 50-day and closing with a really, really ugly, nasty, bearish engulfing candle. And here's IWM, small caps, where they broke down below the 50 and they're holding support right at both the 100 and 200 days. So we do have a lot of technical levels in play. And it's not just the averages. I mean, we can look at like the tech sector. Big resistance here. Support the 100, big resistance on a gap up open on Thursday. Big bearish engulfing candle resistance at that 50-day. The semiconductor index, because this week, NVIDIA was one of the key focal points for the market, and you can see what happened with semis. Gapped up to that 50-day, sold off, and found support again at the 100-day. We've also got the mega cap index, same thing, 50-day resistance right there. So I could go on and on, show you a dozen or 2 dozen more examples, but you get the point. But I want to go back quick to the development of all this. So we saw distribution in 3C selling into price strength in June. Then we started to see trends, price trends break like we're seeing over here. Here's a 2-hour chart of the S&P 500, and we had this massive, really clean uptrend channel from March, and you can see again another change in character in terms of price in breaking down. And here's the exact same thing in the NASDAQ 100, this nice clean uptrend channel breaking down. So remember, I asked, are you seeing anything different? If we're not looking at these trend lines, are you seeing anything different about the price action over here? So it has definitely gone more lateral, more sideways. The question I've been asking, and what I've been telling subscribers on nearly a daily basis, is that price trends don't usually just reverse on a dime, especially a 10-month uptrend or 10-month rally like we have here. So a top in the context of a rally is more often a process, not an event. And that's where you get all these topping formations based on where we are as to when the yield curve inverted last June of 2022, based on the lagged effect of monetary policy and all of those 75 basis point rate hikes starting to be felt now in the real economy. Those have all led me to believe that we're moving into what I have called phase two, which is basically, it starts with the end of this rally. So let's take a look at a couple of other price charts. So here's the S&P with a little bit different trend line. And to me, this looks like a head and shoulders pattern that's forming a head and shoulders top. It's about the right size. We have a left shoulder, we have a head, we have a right shoulder. Volume confirmation is really important. We have the right volume for that. Here's a similar pattern in the NASDAQ 100. This would be the neckline. So sloping necklines in head and shoulder bottoms or head and shoulder tops are not uncommon. This is small cap IWM. This is more, I would say, a complex head and shoulders because we have two kind of defined left shoulders. Here's the head and the start of a right shoulder over here, but this neckline being respected, the trend of that neckline, which is the transition from up to more sideways lateral trend. Not as evident in small caps, but in the S&P 500, definitely. You can see it's much more evident from going up to moving more laterally. So we're going to look at volume confirmation really quick because that's really very, very important in any head and shoulders, top or bottom, to distinguish it from just a random price pattern that is not actually a high probability top. So we're going to use SPY because of the volume. And here we're looking at a 4-hour chart of SPY, the ETF for the S&P 500. So what happens over here on the left shoulder is not very important as far as volume goes. Where it gets really important is from the neckline, the rally from that to the top of the head, which is also where we have that key reversal day right at the top of the head. So what will typically happen is, or what should happen is, volume should decline on this rally and sell side volume should pick up on this decline from the top of the head back down to the neckline. And if you kind of focus your eyes on the green volume bars in this rally, what you'll see is that volume is declining on the rally. And then as we're coming down over here, these red bars, we can see we have heavier negative volume or heavier sell side volume. And then as we get over here to the right shoulder, it becomes even more important. But what you can see is a lot of heavy red volume. So I've looked at a lot of these patterns in different averages, in different sectors that we have right now, and the volume confirmation is there. And I'll show you a few other things that are there as well. As far as S&P sectors on this week, pretty dull action in the cyclicals. So this is the S&P 500, and the white line is my own equal weighted index of cyclical sectors. So you can see where the S&P is rallying here. The cyclicals really aren't playing along down over here. So again, S&P 500 and an equal weight index of mega caps, my own. And you can see they actually did a lot better this week. So they outperformed on the week, probably because of NVIDIA's earnings. One of the weakest sectors or subgroups was the retail sector. And that was down, I think, 4.4% this week. But again, what do you see in the price action? It looks like we have a left shoulder, a big head, and we're at the neckline here waiting for a right shoulder. Now, in a lot of the indices, we already have a right shoulder, but there's room for, because they have kind of like 1 and 2, there's room for another. But in a sector like this, it looks like we have everything but the right shoulder so far. So that'd be a rally to a lower high. And if we look at the daily chart of that sector, retail sector, and look at the volume again with left shoulder, head, and coming down to the neckline for a right shoulder, what you see is this rally over here, and green volume is expanding. That's what you want to see in a healthy, bullish rally, right? But this rally off the neckline to form that head, look what the volume's doing over here, the green volume bars. Quite small, and then we come over here and they actually decrease, but the sell-off from that high, what's happening with the red bars, they're increasing. So we have confirmation. Again, this is what I'm talking about in a lot of these sectors where these head and shoulders are showing up, the volume patterns, which are probably, in my opinion, even more important than the price pattern itself to confirm, they are there and they're confirming. Traders are getting bearish again. We had seen this really bullish sentiment that was getting really frothy, but now what I'm going to do is show you my most shorted index, and what you'll see is S&P 500 and my most shorted index. So this would be a massive short squeeze. But over here, you can see what's happening is the shorts are really jumping in with both feet. With most things in the market, that's a contrarian signal. So there's a lot of short squeeze potential that could give us that rally a bit higher to form a little more distinct right shoulder. I just want to talk about real quick too what caused this sell-off, what started this sell-off with that key reversal day in the S&P 500. And here it is. That's the key reversal day right there. And on that very same day was the first day that the 10-year yield closed above 4%. So 4.00% psychological level. So as soon as that happened, we got this sell-off plus that 4,600 level, which I was talking about. That's important. And now this week we have the 2-year yield breaching above 5.00%. You know, whether it's like 5.2 or 5.02% or 4.99%, there's not a big difference, 3 or 4 basis points, not a big difference. But just like we saw with the 10-year above 4% equally, and now the 2-year above 5%, these are psychological triggers. The human mind just gravitates towards these whole numbers. So real quick, I just want to show you the 10-year yield, and this is the 4% level. And the first time it closed, not just traded above, like over here traded above, but closed above was the 27th of July. That's the exact same day that the S&P put in that key reversal day. So we do have this uptrend here, and it looks like maybe this trend is starting to break and yields are starting to come down. But as the 10-year trend is starting to break, the 2-year yield, which is Fed sensitive, is up there above 5%. So troublesome. And hopefully this chart will make sense and it will give you a little insight as to why. This is NASDAQ 100 futures in the candlesticks and the 10-year Treasury future in blue, which you can use because stocks have had a very strong negative correlation to yields, and yields move inversely to bond prices. So what you're seeing over here is Treasury futures leading the S&P lower because yields are heading higher. So recently, most of the summer, the stock market's disconnected from that very strong correlation, but recently it has reconnected, and you can see how close these two track. So the point, again, being is if yields continue to surge, stocks are going to have a very difficult time. But if we get that 2-year yield back below 5%, and the 10-year yield has broken trend and it is kind of moving back down towards 4%, we can get that kind of bounce or rally that would really fill out those right shoulders on most of the averages and a lot of very key influential sectors like technology. And what we'll do now is jump to the short-term 3C charts. People ask me all the time in these videos what 3C is. It's my own proprietary indicator that basically tracks accumulation or distribution that's not apparent in price yet. Okay, so now we're looking at a 3-minute 3C chart of the SPY, the ETF for the S&P 500. 3C is in orange. So this is that key reversal day I keep talking about. But look what 3C was doing coming into that. It was showing distribution or selling into price strength and pretty heavy. So right as the S&P crossed above 4,600 and failed, the 10-year yield crossed above 4%, we already had distribution. And this is like the beauty of this indicator is that it has the power to contradict price. So it's negatively diverging here. And as we come into recent lows and measured moves are hit, we have a slight positive divergence. So I want to show you where this area is on the S&P's price chart. Okay, so this area is August 18th, right? Where we're positively diverging. We've met the measured moves. Let's take a look at the price chart of the S&P. The 18th is right there. So right at that neckline is where we're seeing some buying in 3C, which to me just only confirms and gives more validity to the idea of this being a head and shoulders top, this being the neckline where it finds support until the right shoulder is formed and it eventually breaks. And now we're looking at QQQ, the ETF for the NASDAQ 100, negative divergence over here, a little positive divergence right over here. Again, the same day, the 18th, let's take a look at the price chart. Here's the NASDAQ 100 on a 60-minute chart. This, get my pointer working, is the 18th, right at that neckline. Here's the Diamonds ETF for the Dow, negative divergence again in 3C. You can see 3C confirming, and as we come into this area, a positive divergence over here. And that positive divergence correlates with support right at this channel that you can see has been rising since March. And here's the short-term 3C chart for IWM. You can see 3C is tracking price lower. It's confirming that decline. And as we get into this area, a little positive divergence. Not huge, but a little one. And that little positive divergence is showing up right here. I think I have the wrong color on my marker, but in any case, right here, which again is a neckline of what looks like a head and shoulders top, just needing that right shoulder to fill out. So considering all that, let's take a look at the longer term 3C charts, which I haven't had need to show. I've known what's going on, and this is why anytime an average moves above 20% off the low, like the Dow did last November, or NASDAQ, and you have the financial media saying, oh, 20% off the low, it's a new bull market. And I kept doing these videos answering the question, are these new bull markets? And the answer for me has always been no. It's because of these next charts I'm going to show you. So this is a 60-minute 3C chart of the SPY. Here's our October lows. Remember that the Dow led this rally. It wasn't really until the new year that the S&P and NASDAQ start outperforming with the mega caps. But what you can see over here is that while 3C isn't horrible, it's not in great shape. It's not making significantly higher highs with price as it should. So if we zoom in a little bit closer, you'll kind of see what I'm talking about. And then right at this high, which is that key reversal day, 3C drops real quick over here. Now I'm going to show you a much broader view that goes out to the 2021 all-time highs right there. This is the all-time record high, and this is the bear market of 2022. Look what happens into that all-time record high. 3C is negatively diverging all the way into that high. So these are long-term charts for a long-term view. They're not, an intraday trading kind of chart. But what you see is the S&P pretty close to these levels over here, but 3C nowhere near those levels. And if we look at it, this is pretty much a relative negative divergence where 3C should be making a higher high with price and is not. And here we're looking at the Diamonds ETF for the Dow. Remember I said the Dow is what really led the October rally right here. Big accumulation into this low, which was a little W base or double bottom, then did nothing. 3C didn't look bad. It was tracking with price, but the Dow wasn't doing anything. It was just moving flat. So into this price strength over here, look what 3C is doing, negatively diverging. And this is, so this is a relative divergence. This is a leading divergence. So it's a much more negative divergence. So the Dow is not too far off its high over here, but 3C is at the lowest level it's been at really in a year. And here's QQQ for the NASDAQ 100. We have the same thing. Remember, in October, nobody liked tech at all. Nobody liked QQQ, October 2022. But our call was that we were seeing accumulation in late December and that the mega caps would lead the rally into the new year, 2023. So we can see that positive divergence right here into the end of January. And then look at 3C, that's a leading positive divergence. But since then, we have a half dozen stocks basically lifting the entire index, NASDAQ 100, and we have 3C negatively diverging. And I'm going to show you a little bit more history here. That's the all-time high right over there for the S&P 500, for the NASDAQ 100, right before we went into the bear market. And what do you see back then? 3C negatively diverging into what was a toppy price pattern anyway. Couple months. Tops are more often than not a process, not an event. And then we look at, where the NASDAQ's been very close to these highs, but look where 3C has been and what 3C is doing. And here's a quick look at IWM small caps. This high, notice where 3C is in this area. We have virtually an equal high, but again, look at that negative divergence in 3C. And if we go back a little bit further, my trusty pointer, you can see higher price in small caps right here than over here, but 3C with a big negative divergence on this important trend time frame. So if you've been following my work, you know about phase one. Phase one's the rally that we got from October. Phase two is where that rally starts to end and the market starts thinking about economic recession a little bit more as the lagged effect of monetary policy hits the real economy, which we can see happening now in a lot of places. So let me give you an example of that. This is 30-year mortgage rate. It is the highest right now that it's been since 2000, and mortgage applications right now are the lowest they've been since 1995. So real estate is one of the first areas you tend to see struggle when we're going into that kind of a recessionary environment. This obviously has a lot to do with the Fed, and this is what the Fed wants. This is what the Fed has been engineering, a recession that kills demand, that kills inflation. So not only are we seeing that lagged effect in terms of the yield shooting up on 30-year mortgage, but we're seeing now that applications for mortgages are at the lowest level since 1995. So it doesn't surprise me at all that we're starting to get these toppy formations. Not even starting, we're pretty much 2/3 or 3/4 of the way through them at the exact same time that I thought that we would see phase two, which was the end of the first quarter, which is the end of June, or I'm sorry, the end of the first half, or the end of the second quarter, which is the end of June, right? First, we saw distribution in mid-June in 3C. Then we saw trend lines breaking into July and August. Now we are seeing the process of tops forming. And not only do we have like these kind of shorter term tops, which are specific to this rally off the October lows. And a lot of times they're, I guess what you could say, somewhat proportional. You don't usually see a 10-month rally just turn and go down. You know, a top is a process of distribution. So this looks to be about the right size, considering the length and the intensity of this rally, and it's coming at the right time. But beyond even just this top, we have potential larger double tops in the making as well. So here I've jumped back to a daily chart of the S&P 500. This is that kind of toppy zone. Couple videos ago I said 4,500, 4,600 are really key levels. I'm going to show you why, because if we go back to the high or the top, this is the bull market high, record high for the S&P 500, those two levels were important. So right here was kind of almost a neckline for our little top right here in the S&P at 4,500, at 4,600, break and resistance. That's why these have been two very important levels in my mind, and we see a key reversal day just recently right there at 4,600. But the bigger point I'm trying to make, and I might need a little longer chart, is the potential of this being a double top. So I've just kind of zoomed out to a 2-day chart. There's the COVID crash, there's the Fed pumping all kinds of liquidity into the market, there's our rally, right? Here's our top. And this is what I think is potentially a double top on a kind of a longer term macro basis. We have that small or smaller head and shoulders right in here. We had quite a few head and shoulders right in this area, but this double top is what I'm looking at. And we have the same exact thing when we look at the NASDAQ 100. You can almost see right over here this kind of head and shoulders type formation or toppy formation. But what's more interesting is here's the big rally and then the potential right here of a double top. Price doesn't have to come all the way up to that level to make it a double top. Most of the last few months in mega caps and tech, the rally has been driven by this whole AI narrative, and NVIDIA is the poster child for that narrative. What I want to do is show you one of my subscriber posts, the daily wrap. I put it out every night after the market closes, except for Friday, and talking about NVIDIA the day before earnings. And I hope you can see this post well enough, but it was Tuesday, August 22nd, the day before NVIDIA reported after the close. And what I was talking about, you can pause the video and look, was my view that it was traders and not institutional money, strong hands or diamond hands, in today's parlance, was not institutional money that was driving price higher. I can tell that in a few different ways. One of them is 3C, but what I kept mentioning was the 475 level acting as resistance. Now, by all accounts, NVIDIA blew out earnings expectations, right? I think the stock was up 12 or 14% in after hours. It lost all of that on Friday in the cash market. So let's jump back to that chart of NVIDIA, and there's the 475 level I'm talking about. Here's the big gap up right here on Thursday morning after they reported Wednesday after the close. I think up about 10% or so in the cash session. Look where the close is. This is 475 resistance. Resistance here, resistance here, resistance here, resistance here. This is the day I was talking about on Tuesday at 475. So this really just makes me question whether or not tech, which has been, or tech and mega caps, has been the only thing really leading this market higher all of 2023, is still in the game. And when I look at NVIDIA and basically institutional money selling the news, selling the good news, it makes me think no. I already showed you the 10-year yield and how it looks like it may have broken that uptrend from the 4% level, but we still have the 2-year above 5%. That's going to be really key. If those can come down, then I think we can rally a little bit more. We get that right shoulder formed in some areas where it's not, like small caps. And typically September, especially the first 2 weeks of it, the first half of the month, are not great from a seasonal perspective. But we also have earnings season ending, and we have the reopening of that buyback window for all these companies who have pledged to buy back shares, which NVIDIA did. So that could provide a little bit of a boost for the averages, and perhaps what we'll get is a little bit more structure. Head and Shoulders tops don't have to be symmetrical, but they often are. What I mean by more structure, let me just move this chart over, give us some space to look at it, extend this trend line a little bit. And what I mean is we kind of have almost two shoulders here, right? On the left side, and here's our head. And then we come back down to the neckline. So we definitely have one shoulder. What's interesting, this is 2.8% rally from the neckline to that high. Same thing right here. So it's exactly the same. Perhaps we get, something like this. And then we come back down to the neckline. I don't know, because there's, to me, this is probably well formed enough in the S&P and the NASDAQ. In other areas like small caps and some sectors, we don't have those right shoulders. So a bounce like this can help us form those right shoulders. You can go tactical long. And ideally, what I would be looking to do, because I've been bullish since really September, looking for bases in October of last year, have not deviated from that, have not recommended any shorts long term. But if we can get something higher, a higher bounce like that, not only would I be saying, I think this is a great time to sell into that price strength, it would also be a good time to open some big shorts, because eventually, if this Head and Shoulders plays out like I think, it breaks this neckline and our rally is done. So I hope you enjoyed the video. I know it's a lot to take in. If you have questions or comments, feel free to leave them in the comment section below. Check out the description of the video, so we'll tell you a little bit about the current website and the new website and what's going on with that. And if you're not already a subscriber, please smash that subscribe button, hit the bell for notifications, and a thumbs up if you like the video. That would be great. Thanks for sticking around, and enjoy your weekend. Members, I will see you on Monday.